Gentlemen, I have spent the last 12 months tracking every dollar of capex, every major earnings beat, and every secret contract signed by the world's biggest tech giants. And right now, I have identified 5 specific companies are positioned at the epicenter of a $100 billion infrastructure war. While the retail market panics over headlines, smart money like BlackRock and Vanguard is quietly consolidating positions. And these aren't just stocks, they are the physical backbone of the 2026 economy. If you miss the shift from AI stories to AI infrastructure, you're investing in the past. So here is my must-buy list for the rest of the year, starting with the cash flow king, Meta. This company is an absolute beast. On Jan 16th, I posted a video telling everyone that this is the moment to start buying Meta, and its stock was trading $600 per share. Today, Meta just released their Q4 results for 2025. It is an absolute banger, closing at $738 per share. That's a massive 23% since I mentioned. But that doesn't matter. Let's look at their Q4. Meta did $59.89 billion in revenue, and for full year 2025, it did $297 billion. Their family of apps reached about 3.58 billion daily active people, which is basically global scale attention. And the ad engine is still firing. Ad impressions were up 18% year over year in the quarter, and the average price per ad was up 6%. And Meta is spending aggressively. It reported about $72.22 billion in capex for 2025, and multiple major outlets have reported management is guiding 2026 capex to roughly $115 to $135 billion. That is massive. But it's also the point. Meta is trying to lock in compute capacity and build AI products that increase engagement and improve ad performance. This is why I keep buying it. Meta's upside in 2026 isn't more social media. It's AI monetization at the point of distribution. If Meta improves recommendation quality and ad targeting, the revenue per user goes up without needing new users. And if Meta monetizes WhatsApp harder, that's an underappreciated lever. One report noted WhatsApp paid messaging surpassed a $2 billion annual run rate. Now the money part, in that same quarter, Meta produced about $14.08 billion in free cash flow and $43.59 billion for the full year. It ended the year with about $81.59 billion in cash and marketable securities. That kind of cash generation matters because Meta is not asking investors for capital to build AI. It's funding it internally. The risk is obvious: capex. If spending grows faster than revenue and margins compress, the stock can re-rate. But I don't really care about that, as the cash flow base is just so large that Meta can afford to take that risk without financial strain. Now, stock number 2, Nebius Group, ticker NBIS. Nebius is a pure-play AI infrastructure company. Think renting AI compute, but more specifically, building full-stack cloud infrastructure optimized for AI workloads. This is the layer below apps. It's the picks and shovels trade for the AI build-out. And here's why it's on my 2026 list. Nebius has been landing headline deals with the biggest names. Reuters reported a $3 billion 5-year agreement with Meta to supply AI infrastructure. Reuters also described earlier hyperscaler scale contracting with Microsoft. These deals are important because they validate that Nebius is not just a story, but as a part of the real AI supply chain. Now the numbers, and this is where you have to be honest, Nebius is still in heavy build-out mode, meaning growth comes with losses. In Q3 2025, Nebius revenue jumped 355% year over year to $146.1 million, while capex surged to about $955.5 million. That's not efficient, that's we are racing to build capacity. Nebius has also talked about targeting $7 to $9 billion in annualized revenue by the end of 2026, which shows the ambition but also shows how execution dependent this is. AI infrastructure is turning into a capacity game. When demand is larger than supply, the companies building supply at scale can grow insanely fast. Nebius is also expanding power access and data center footprint, and that matters because electricity and land are becoming AI bottlenecks. Smart money understand this. A 13F HR filing from November 12, 2025 showed that BlackRock increased its ownership of NBIS by a massive 294.15% during the third quarter. Stock number 3 is IREN, ticker IREN. IREN is a hybrid story. It's a Bitcoin mining company that is increasingly repositioning itself as an AI and high-performance compute infrastructure company. In other words, it's trying to turn cheap power plus data center build-out into multiple revenue streams. In other words, it's trying to turn cheap power plus data center build-out into multiple revenue streams. The recent earnings numbers were big. In its Q1 FY26 results, IREN reported total revenue of $240.3 million, up 355% year over year. Most of that came from Bitcoin mining revenue of $232.9 million, but it also reported AI cloud services revenue of $7.3 million, which shows the AI segment is real but still early. It also reported adjusted EBITDA of $91.7 million, and it reported net income of $384.6 million, though that includes unrealized gains tied to financing instruments. There's the reason IREN stays on my buy list, the Microsoft contract. IREN announced it secured a roughly $9.7 billion AI cloud contract with Microsoft over 5 years, including a 20% prepayment to provide access to NVIDIA GB300 GPU capacity. That's a signed multi-year commercialization pathway. So the bull case is simple. If IREN executes, it becomes a picks and shovels AI data center play with a massive anchor customer, plus a Bitcoin mining business that can throw off cash when crypto is strong. I'm not just betting on Bitcoin, I'm betting on the demand for compute and power. Now, stock number 4 is IONQ, ticker IONQ. IONQ is a quantum computing company, and this is the highest optionality stock on my list. Quantum is not a one-quarter story. It's a multi-year technology curve. So you buy IONQ if you believe the tech is moving from research toward practical advantage. The most recent earnings data we have is IONQ's third quarter 2025 report. IONQ reported revenue of $39.9 million for the quarter, up 222% year over year. Management also said it beat the top end of prior guidance and raised the high end of full-year guidance to $110 million. IONQ also reported a very large pro forma cash position of about $3.5 billion after a $2 billion equity offering, which is important because it means they have runway to invest. But the reality is, IONQ is still losing money. It reported a net loss of $1.1 billion in that quarter and an adjusted EBITDA loss of $48.9 million. That's the price of building early. So why keep buying? Because the payoff curve is asymmetric. If IONQ's tech roadmap keeps hitting milestones and commercial contracts accelerate, the upside can be enormous. And IONQ has been stacking credibility signals, acquisitions to build out a full-stack platform, and technical claims like 99.99% 2-qubit gate performance. This is hard for most to understand, but just know this. IONQ is the only company that has a 99.99% 2-qubit gate performance. Note that the risk here is the timeline. Quantum can take longer than investors expect. The stock will be volatile, and it can draw down hard if hype outruns progress. This is why IONQ is a small slice position, not a core holding. Finally, we have Cameco, ticker CCJ. Cameco is one of the most important names in uranium, and it also owns 49% of Westinghouse, which gives it exposure across more of the nuclear value chain than most investors realize. The nuclear story is back for a simple reason. Electricity demand is rising, and always-on clean power is becoming strategic again. AI data centers, electrification, and grid stability all push governments and utilities to take nuclear more seriously. Now the numbers. In its third quarter 2025 results, Cameco reported adjusted net earnings of $32 million and adjusted EBITDA of $310 million. It also reported a strong balance sheet with $779 million in cash and cash equivalents, $1.0 billion in total debt, and a $1.0 billion undrawn revolving credit facility. The Westinghouse piece matters. Cameco reported that Westinghouse's results were improving and that Cameco received a $171.5 million distribution representing its 49% share from a project-related cash event. That is real cash returning to the parent. Cameco also accelerated its dividend increase to an annual dividend of 0.24 per share. That's not why you buy Cameco, but it signals confidence and financial strength. Cameco has been a monster performer. Over the past 12 months, it went up roughly 176% and up sharply year to date in January. That performance reflects the market pricing a nuclear renaissance, but the bull case is that uranium contracting and new build expectations can keep the cycle supported. So why is CCJ a keep buy in 2026? Because it's a way to own the nuclear fuel cycle and the Westinghouse optionality in one liquid ticker. If nuclear build-out and life extension continues globally, Cameco stays in the center of that spending. Now let me give you the clean framework for how I'm buying these 5 through 2026. Meta is my core compounder. It's AI distribution plus cash flow. Nebius is my high-growth AI infrastructure bet. IREN is my power plus compute hybrid with a real Microsoft contract, but it's volatile. IONQ is my long-horizon technology optionality. Cameco is my nuclear and electricity scarcity bet. I don't buy these with one lump sum and pray. I scale in. I buy more on big red days. I keep positions sized appropriately to their volatility. Meta and Cameco can be bigger core positions. Nebius, IREN, and IONQ should be smaller because the drawdowns can be violent. Thanks for watching. Drop a like, subscribe, and comment in the section below what you'd like to see next.